Rebalancing. Learn the time-tested strategy of spending a little time to get disproportionate results. What is rebalancing? When you started, I assume you had a plan. Yes, an asset allocation plan, like we talked about earlier. Well, over time, our investments will increase or decrease in value. That's natural. Some investments may do extremely well while others may tank. This disturbs the balance. In order to restore that balance, we readjust your investments so that they're aligned with your original asset allocation plan again. What we're doing in reality by rebalancing is managing risk. Yes, investing's most important strategy, trying to reduce risk as much as possible. Let me just refresh your memory again. If you take care of the downside, the upside will take care of itself. Okay, let's find out why it's necessary to balance things and make peace with yourself. Rebalancing forces you to sell high and buy low, so you can book some profits as you go and use the proceeds to buy into better opportunities. By selling what's gone up and buying what's gone down, you're taking your profits as they come and acquiring cheaper and less expensive assets. This will ensure your risk-reward ratio is maintained. Let's take an example for how rebalancing works. You start with a portfolio of 50% stocks and 50% bonds. Although this isn't well balanced, let's just go with the flow for a minute. Over time, because change is inevitable, the value of your stocks go up by 30% and the bonds go down by 10%. Let's just say. But overall, we're up by 10% in total. We now have a challenge. Our portfolio is unbalanced, heavily skewed with stocks. What do? You rebalance, at least once a year according to your asset allocation model. Now, you have a rebalanced portfolio which is in alignment with your asset allocation model and ready for further growth. But how do you actually do this? Let's find out. There are two ways of doing this. The first is to sell everything and buy everything again as per your asset allocation model. This is the easiest and it doesn't require much maths. But do this only if your transaction costs are extremely low. For example, my broker, Interactive Brokers, the one I use, they can do this for as little as $1. There's also an advantage to this. Let's say you originally invested $10,000 and it was up by 500. You would sell the entire portfolio and start your asset allocation afresh with an investment of $10,000. This ensures that you book your profits each and every time. You wouldn't do this if you were making a loss. Instead, you just rebalance by the preferred asset allocation that you have. That's what the second method is all about. Readjusting by selling enough of the gains of one asset and using the proceeds to buy cheaper assets. Okay, so how often should you rebalance? Just as you would go to the doctor for a medical checkup, which by the way I recommend once a year if you're below 30 and once every 6 months if you're above 30. It's a good idea to check in on your portfolio to make sure everything is running fine. And this is a problem that I see with a lot of people. They just forget about their investments and just things go on, life gets busy, and one fine day, they open up their account. Don't do this. It's the biggest mistake we make. Check in regularly. There are two ways of doing this, by time or by percentage. By time is when you rebalance every quarter or every 6 months or every year. The choice is yours. In fact, for the gone fishing portfolio that I recommend, that's exactly what you're supposed to do. I spend just 1 hour selling and buying to rebalance. Though most studies indicate the difference in both return and risk is slight whichever frequency you choose, some research actually suggests that the annual rebalancing can result in slightly better returns than more frequent rebalancing without increasing volatility. Whatever method you choose, keep in mind that each time you rebalance, there's going to be a transaction cost to execute the order. I thought I'd leave you with some interesting food for thought. The Book of Changes suggested 2,700 years ago that the universe changes every day. Whilst change happens consistently in cycles, there are some unchanging rules. Seek those rules out and you can bring balance to your world of investing.